Master budgeting. Hello, all. Let's look at a master budgeting problem for a merchandising firm. The management of the Bears Lumber Company in Northwest Indiana has asked you to prepare a budget for January, February, and March. Any type of budget preparation requires actual data, assumptions, and some projections. For this problem, the assumptions and projections are in the assumption schedule, while the actual data can be found on the December 31st balance sheet. Let's get started. The master budgeting process always starts with the sales budget. For our problem, the sales budgeted for January, February, and March are $309,000, $329,000, and $229,000 respectively. Since we know our sales budget, we are able to determine the expected cash collection schedule for the quarter. For our problem, all sales are credit sales. There are no cash sales. As can be seen, our collection rates are 70% in the month of the sale and 30% in the month following the sale. For January, we will collect the accounts receivable from the December balance sheet of $86,500 because this amount represents the 30% from December sales which had not been collected in December. To that, we add 70% of January sales of $309,000 or $216,300 for a January total of $302,800. For February, we collect the remaining 30% from the January sales of $309,000 plus 70% of the $329,000 of February sales. Our total expected cash collection for February is $323,000. For March, we do the same thing. We first collect the remaining 30% from the February sales of $329,000, and then we collect the 70% of the March sales of $229,000 for a total of $259,000. To get the quarter totals, we add across and then down to get a total estimated cash collection of $884,800 for the quarter. Our next step is to move on to the merchandise purchases budget. As a merchandising firm, we need to purchase the merchandise that we intend to sell. Our assumption schedule states that the cost of goods sold are 75% of our sales. The problem also states that our company needs to have an ending merchandise inventory equal to 80% of the following month's cost of goods sold. So we want to make certain that we purchase enough merchandise to cover all of our sales, plus allow for an ending balance in our merchandise inventory account. The sum of these two amounts is known as our total merchandise purchases needs. But wait, our total needs are not the same as our required purchases. Because we will always have an ending merchandise inventory balance, our required purchases will be determined by subtracting our beginning merchandise inventory from the total merchandise needs. The determination of the required purchases for January starts with budgeted sales of $309,000. To get our cost of goods sold, we multiply the $309,000 of sales by the 75% assumption, the result of which is $231,750. We do the same calculations for February, March, and April. For February, we multiply 329,000 of sales by 75% to get a cost of goods sold of $246,750. For March, we multiplied $229,000 by 75% to get a cost of goods sold of $171,750. For April, we multiply $250,000 of sales by 75% to get a cost of goods sold of $187,500. It's time to determine our required ending merchandise inventory. Our assumptions tell us that the required ending merchandise inventory is to be 80% of the following month's cost of goods sold. The ending merchandise inventory for January is 80% of February's $246,750 of cost of goods sold, or $197,400. For February, we multiply 80% by the March cost of goods sold of $171,750 to get $137,400. For March, we multiply 80% by the April cost of goods sold of $187,500 to get $150,000. Now that we have our cost of goods sold and required ending merchandise inventory for each month, we add the two amounts to determine our total needs. For January, we add $231,750 plus $197,400 to get total needs of $429,150. For February, we add $246,750 plus $137,400 to get $384,150. For March, we add $171,750 to $150,000 to get $321,750. At this point, we have our total needs for each month. Our total needs, however, do not represent our required purchases because we start each month with a beginning inventory. The beginning inventory for any period is always the ending inventory for the prior period. For January, we get our beginning inventory by looking at the December balance sheet. The December balance sheet shows an ending inventory of $185,400. We subtract the $185,400 from the total needs amount of $429,150 to get our required purchases of $243,750. For February, we will subtract the beginning inventory of $197,400 from the needs of $384,150 to get required purchases of $186,750. Remember, the beginning merchandise inventory in any month is the ending inventory from the prior month. In this case, it's $197,400. The required purchases for March are the total needs of $321,750 minus the beginning merchandise inventory of $137,400 or $184,350. To get your required purchases for the quarter, you add your monthly cost of goods sold amount of $231,750 plus $246,750 plus $171,750 for a total of $650,250. To the $650,250, you add the ending merchandise inventory of $150,000 to arrive at total needs of $800,250. From the $800,250, you subtract the beginning inventory of $185,400 to determine the total required purchases for the quarter of $614,850. You should note that when it comes to merchandise inventory balances that we do not add the months across. Income statements like sales and cost of goods sold represent flows of revenues and expenses during the period, which are needed to get a total for the quarter. Merchandise inventory is a balance sheet asset, and as such represents a snapshot of the balance at a particular point in time. The beginning balance is always the beginning inventory from the first period shown, in this case, the month of January. The ending balance is always the ending inventory from the last period shown, in this case, March. We've just completed the merchandise purchase budget. It was a merchandise purchase budget because the Bears Lumber Company is a retailer. Had the company been a manufacturer, we would have completed a production budget, followed by a direct materials, direct labor, and manufacturing overhead budgets. The production budget would tell us how much we needed to produce. The direct materials budget would tell us how much direct materials were needed in both units and costs to satisfy the production. The direct labor budget would tell us the cost of labor needed to produce our product, and the manufacturing overhead budget would tell us how much overhead would be applied to the production process. We will next prepare the cash disbursement schedule. This schedule determines when and how much will be paid for our merchandise purchases. For our problem, no payment is made during the month of the merchandise purchased. All purchases of merchandise are added to the accounts payable balance at the time of the purchase. We do, however, pay the entire balance in the following month. Paying the entire balance means that we will reduce the balance in accounts payable when the payment is made. Our disbursement for January represents the payment of the December 31st balance sheet balance in accounts payable of $258,000. February's disbursement totals $243,750, which represents the required merchandise purchases for January. March's disbursement totals $186,750, which was the required merchandise purchases made during February. The total for the quarter is the sum of $258,000 for January, $243,750 for February, and $186,750 for March, for a total of $688,500. This total is the expected cash disbursement for merchandise for the quarter. The next step is to prepare the cash budget for the quarter. Cash budgets begin with the cash balance at the beginning of the quarter of $36,000. For our problem, this amount is taken from the December balance sheet. Remember, when we are dealing with balance sheet accounts, the ending balance for one period is the beginning balance for the next period. To the beginning cash balance, we add the expected cash receipts for the quarter of $884,800. This amount will always come from the expected cash collection schedule. Adding the $36,000 and the $884,800 gives us total cash available of $920,800. From the cash available amount, we subtract cash disbursements for merchandise of $688,500. We also need to deduct cash paid for operating expenses. Our assumption schedule states that cash paid for operating expenses will run at $23,000 a month for a quarter total of $69,000. Subtracting the cash disbursements from merchandise purchases of $688,500 and the cash paid for operating expenses of $69,000 results in an ending cash balance of $163,300. It is important to note that the cash budget can only be prepared after a series of other budgets and schedules are prepared. In this case, we needed to have completed the sales budget, the merchandise purchases budget, the expected cash collection schedule, and the cash disbursement schedule. In addition, we needed to subtract cash paid for operating expenses as provided in the assumptions. Note that because depreciation is a non cash expense, it gets excluded from the cash budget. We can now prepare our financial statements. We always start with the income statement. The problem asks that we determine the net operating income for each month as well as for the quarter. The sales budget called for January sales of $309,000, February sales of $329,000, and March sales of $229,000. Sales revenue for the quarter totaled $867,000. The merchandise purchases budget called for a January cost of goods sold of $231,750, February cost of goods sold of $246,750, and March cost of goods sold of $171,750. Cost of goods sold for the quarter totaled $650,250. Gross margin is determined by subtracting cost of goods sold from sales revenue. The gross margin for January is $77,250. For February, it was $82,250, and for March, it was $57,250. The gross margin for the quarter was $216,750. Our operating expenses were $23,000 per month or $69,000 for the quarter. Depreciation expense was $30,500 per month or $91,500 for the quarter. Subtracting the operating expenses and the depreciation expense from the gross margin resulted in a net operating income for January of $23,750, $28,750 for February, and $3,750 for March. The net operating income for the quarter totaled $56,250. For the income statement, the quarter totals can be determined by adding each month across or by calculations from the column labeled total. The final step is to prepare the balance sheet for the quarter end. Remember that the balance sheet provides a snapshot of the company as of a given date. For our problem, the date will be March 31st. The balance sheet is based on the accounting equation of assets equal liabilities plus owner's equity and lists the company's assets, liabilities, and owner's equity account titles and amounts. Like the accounting equation, total assets must equal total liabilities plus total owner's equity when all is done. For our balance sheet, cash is taken from the cash budget and is $163,300. Accounts receivable comes from the expected cash collection schedule and totals $68,700. The $68,700 represents the 30% of March sales which has yet to be collected. 30% times $229,000 is $68,700. Merchandise inventory is taken from the merchandise inventory purchases budget and is $150,000. Property, plant, and equipment is determined by taking the previous balance and adding any new purchases while subtracting the depreciation expense for the period. Since there were no additional purchases, the property, plant, and equipment of $832,500 was determined by subtracting depreciation for the quarter of $91,500 from the December balance of $924,000. Now we add each of our assets, and when doing so, we get a grand total of $1,214,500. Now let's move on to liabilities and owner's equity to see if we balance. Accounts payable represents the amount we owe to vendors for merchandise purchased but not yet paid for. The amount comes from the merchandise purchases budget. Because the assumption made is that all required purchases of merchandise are paid for in the month following the purchase, the accounts payable at the end of March is $184,350. That amount represents the required purchases for March. The next line item is common stock. Because there was no mention of stock issuances or stock buybacks, common stock remains at $759,000. Retained earnings is determined by taking the prior balance, adding net income, and subtracting any dividends declared. Since there was no mention of dividends, we take the December balance of $214,900 and add the quarter net income of $56,250 to get a new balance of $271,150. Adding the accounts payable of $184,350 to common stock of $759,000 and retained earnings of $271,150 gives us a total of $1,214,500. We balance. Our assets equal liabilities plus owner's equity. That's it. You've completed a comprehensive problem on budgeting. I'm sure that you'll note that the math is not bad. The difficulty rests in understanding the sequence to be followed and knowing how to apply the assumptions throughout the process. You learn this by practice. Thanks for watching the video. Good luck.